So the tenets, the step one of the strategy that I use. So I set the current time, I'm in replay mode, and it's at 6:45 a.m. Central Time. And what I'm looking at here is current price within relationship to what was, so this is, as an example, Friday morning. So the settlement price for Thursday evening was right here at 15,256. So I notice that current price is above settlement price. Then the next thing that I look at is, was the overnight low traded? And what I mean by that is anywhere between the next, the next night's opening range. So in my case, 5 p.m. Central Time. So there was a low made here at 6:30, which is pretty common. So that low, did it get traded yet? And the important part is yet. And did it matter? So in this case, you can see that it got traded at 3:30 in the morning and at 5:45. And the very critical part is, did it actually hold? So in this case, it did hold, but so this is actual double confirmation. So that would have actually been a valid hold there. In this case, it traded just below that candle, which is a good thing because what happens is, and this is part of the theory, where do people put their stops? They put their stops right below that low. So these guys here bought long and they put their stops right below here. It's just what people do. This guy traded down, took the stops out, and traded up. That's very important to understand that. And everything is based on market auction theory, meaning down here, everybody said price is cheap. I want to buy a hot dog I can get a hot dog for $2. So everybody's like, price is cheap. Up here, price is too expensive. I'm going to get rid of my hot dog. I won't buy it. So then price has to come back down until it's cheap enough. That's the whole theory. It's super simple and it works on human nature. You go to the hot dog store, you go to the grocery store, hot dogs are on sale. Everybody buys them. Go to the grocery store the next week, hot dogs are not on sale. No one wants to buy them, so price comes back down. Now, there's more pieces to this, but that's the base of the whole theory. So I'm looking at this Friday morning. Market has not technically opened yet, the regular trading hour at 8:30 Central Time. So I'm looking to see what's my expectation for the day. Well, in this case, since the overnight session has traded and the low was taken out, then there's a 70% chance that the day is going to be a strong up day. Then, or at least I'm going to be looking for longs. Then, not only that, but the overnight high has already been traded through. That means we got a trend day on our hands. And these are 15-minute candles, but that doesn't matter. A candle just does not matter yet in this whole concept. So if I were to look at this day, I would take and draw a line right here, and this is overnight low. Then I take another line, and I would put on these red candles and mark this overnight high. Okay, this guy here. Why I do that is because now I visually am looking at this and saying, uh-oh, we already are above this overnight high. We traded through it. That's very important. We traded through it. It didn't come up to it, take stops out. I would expect this red candle right here. It trade up to it. It looked like this candle right here. See how it traded up? Took the stops out, didn't trade over. And then really came down and people bought and it kept on going. So it traded through it. So again, we're looking for an update. And we're not looking for price to come back down to this level at all because it all got traded out and it's so strong that's up. So now we're looking, how can we get in? How can we get long in this position? And you could possibly say there is no trade for you because you missed it already. And that's okay if that actually happened. All right, but that's what I'm looking at 7 in the morning, thinking about what I'm going to do in the market. So I'm going to stop right there and use that example. I'll have more.